I think 2020 will be a very good year for emerging markets, still an up year for developed markets, including the US equity market. We've been spending a lot of time looking at the earnings forecasts in both developed and emerging markets. So the forecast for this year for developed markets is around 9% EPS growth, and for emerging markets around 15%. When we look at the developed market numbers, we see a few risks perhaps in industrials, but generally the numbers look reasonably robust. And it is important when you look at equity markets to understand what are the main stocks in those markets, what really drives them. And over time, since really the GFC, we've evolved into having equity markets with a bias towards secular growth rather than cyclical stocks. So think about some of the big names in the US, whether in the internet space, the tech space, e-commerce, etc. These are the really important things rather than your old industrial stocks that perhaps a few decades ago you would focus on. We've got the US economy slowing a bit into 2020 with just 1% GDP growth. But even with those numbers, we think we will see earnings growth in US equities. Valuations are high. We are just under 19 times forward on the S&P. That is at a two-decade high, not quite the 24 we got to in the late 1990s, first quarter of 2000. But the context of that high valuation is a stock market with a bias towards secular growth, but much more importantly is an environment of what we define as need and fear. Investors require a return. If you have a pension fund, an insurance product, the return that's available in the fixed income market is too low to meet your liabilities. Equities look inexpensive versus fixed income. And so we have an environment where investors are long equities due to need rather than due to greed. When we move to the emerging market story, EM in the last decade, the 2010, was a significant underperformer of developed markets. And that was all about earnings growth. Developed market EPS growth compounded at an 8% in the last decade. It was only 3.6% compounded EPS growth from emerging markets. So it's hardly surprising it underperformed, and it's hardly surprising that weighting towards emerging markets is very low. Looking forward, the number for 15% EPS growth in 2020 for EM, I think is reasonably robust, with upside risk coming out of tech and also upside risk coming out of financials. I'm expecting a good inflow into emerging market equities, which will be about repositioning after a substantial period of underperformance. Right. So it's going to be, in my view, a pretty decent 2020.
Adrian, according to you, what gives at this point? We've been in a more than a decade-long bull run. Money is coming in cheap and easy, and it continues to do so. Monetary and fiscal gives have also come in, which has also led to the equity market rally. Do you feel at any point that you're going to see growth starting to bottom out, particularly for countries like India, which have seen a print of 5% of late?
Yeah, so I dispute the hypothesis around central bank easing, growth and balance sheet is the whole story for the move in equity markets. The compounded EPS growth for a decade has been over 8% for developed markets. That is the prime reason that they've gone up. The US earnings per share performance has outperformed. So this is a story of, yes, a little bit of PE re-rating, which has probably got much more to do with where interest rates are. And interest rates are low because growth is low and inflationary pressures are low. So the question is, can this continue? Well, the trend is in place. I don't see an inflection point that causes that trend to deviate as of now.